Daily Fiscal Pulse for the 5th of August, 2026. We're working with Wednesday's settled data here, so these numbers are final, not preliminary. Let's start by stepping back and looking at the bigger picture. Right now, there's no clear dominant narrative shaping the overall direction. The headlines making noise are about copper jumps to its highest level ever, what the metal is telling us, and they are definitely having an impact on how prices are moving. That said, headlines only tell part of the story. The actual cash flows paint a fuller picture. In today's session, the net fiscal transfer came in at $4.9 billion. Tax receipts did the heavy lifting, delivering $14.9 billion. On the surface, nothing jumps out as particularly remarkable. But the equity index tells a somewhat different tale. ES futures wrapped the day at 7,748, staying comfortably above the 20-day moving average of 7,546. If you plot the full 20-day range, you're looking at roughly 474 points of trading space. The fact that price is holding steady despite fiscal headwinds is worth noting. Pull back a bit further and the picture sharpens. Government spending over the last 5 days is averaging $27.8 billion daily. Now compare that to the 20-day average sitting around $9.7 billion. More cash is flowing into the real economy and then into asset prices. Take an even longer view and the year-over-year numbers reinforce the same message. Fiscal year-to-date spending stands at $1,455.4 billion, roughly 13% below where we were at this point last year. That's a substantial dial back in the amount of fiscal support flowing through the system. From a market positioning angle, the fiscal backdrop isn't exactly screaming opportunity or danger. Our conditions gauge is at -41. But here's the thing. We've been here before, many times. And historically, even when liquidity tightens, the S&P has managed to post around plus 1.5% gains over the next month on average. Markets don't follow liquidity in lockstep. They can, and frequently do, edge higher anyway. There is one positioning signal worth flagging though. Leveraged funds keep adding to long bets while margin debt has climbed into the 100th percentile. That's elevated by any measure. When margin reaches those levels in the past, it's usually functioned more as a caution flag than a bullish one. So here's how the pieces connect. With fiscal flows coming in below last year's pace, there's less of a buffer built into the system. On days when the news cooperates, markets can still climb. But if a risk event pops up, say an escalation tied to no clear dominant narrative, selling pressure can accelerate faster because there's simply less liquidity underneath to absorb the move. A few scheduled events could shift the dial ahead. The 12th of August marks the Social Security payment cycle on the second Wednesday of the month, and that can reshuffle near-term flows. The next major Treasury coupon interest payment window sits right around the 15th of August. Fiscal conditions are in a restrictive zone right now, but it's the magnitude of the tightening that really matters going forward. Keep an eye on those scheduled flows. That's our next signal to watch.